All right, hey, ladies and gentlemen, welcome to another episode of Beyond Seven Figures podcast. If you're listening to the Beyond Seven Figures podcast, I know one thing about you. You love keeping your money. You love investing your money and watching it grow. So, a while ago, one of the guests in the podcast, a guy named Garrett Gunderson, great dude, good friend of mine. And Garrett brought up this reframe when it came to money that I thought was really brilliant. And he said, so many people think about looking at all these investments and whatnot in order to try to grow it, whether they're throwing crypto or whatnot. They want to grow their capital. Look at somebody like Warren Buffett. If he's able to do 20 something percent a year, like he's doing backflips, super excited. But he said, the real secret to really accumulating wealth begins with keeping your money. So, like many of our listeners, they're high earners. They could be spending 40, depending on when they're living, upwards of 50+% a year, giving that all away to Uncle Sam. Just imagine for a minute then. Imagine if your investments returned 40%. Or even if you're not making that much, maybe if you're a little lower and you're making 30, maybe you're taxed at 35% or whatever that is. What if your investments made 35%? Would you be happy? 40%? Happy? 50%? You should. So I wanted to bring a guest to you today that speaks more on how you can save that money. Now, many of our listeners are either planning an exit or would like to have an exit at some point and walk away with millions of dollars, potentially generational wealth. If that is your aspiration, likely something that you want to start planning well before that exit event happens. We had a client recently, somebody came knocking on the door completely unprepared, gave them tens and tens of millions of dollars. He took it, which was a smart move. But at the same time, he ended up giving several million dollars away that he shouldn't have given away because he didn't plan appropriately. So, our guest is one of the world's leading experts, takes a little different angle than you might hear from your traditional consultant or traditional accountant, which is why I wanted you to hear it from him directly. Vincenzo Villamena, welcome to the show. The Online Taxman, right?
Thank you. Thank you for having me.
Yeah, no worries. You and I have known each other.
Yeah, it's been a while. I've been in NYC for 10 plus years. So I feel like it's been over that time, sort of, via that network.
Yeah, for sure. And your approach is fascinating to me because you talk to your normal accountant and they're going to talk about establishing trusts and all this other fun stuff, which is great. You take a different approach, and a lot of that has to do with overseas and structuring, business and tax savings that way. Can you just go into a little bit more detail as to the advantages of doing something overseas, why that actually is available to Americans, and just kind of paint a bigger picture for us. Like, why should our listeners be paying attention to this conversation?
No, it's a good point. My lifestyle in the last 14 years has been outside the United States. And you sort of see it a little bit now with the trend of, a lot of people moving to Texas and Florida to avoid state tax. But, really over the last, it's been, many years, there's also been this option to actually move abroad, right? And of course, we've heard of Puerto Rico, but really there's a few advantages if you qualify to be just a U.S. expat, an American living outside the U.S. And one is you get really the first $126,000 tax free, right? And so your salary that you would earn from whether it's a U.S. company as a CEO or being an independent contractor, being a consultant, you're allowed to pay yourself $126,000 and also potentially your spouse, and that's tax free. So that's sort of step one. That's called the foreign earned income exclusion. But step two is when it gets interesting because the potential to set up an offshore structure. And, there are stipulations and whatnot about this that I'll get into a bit. But, really, if you set up a company outside the United States, right, and it could be in any one of these low tax or no tax jurisdictions, whether it's, Hong Kong or British Virgin Islands, Dubai, you set it up in that jurisdiction and you have no U.S. effectively connected income. What that means is, you have no U.S. employees, like no employees that live in the United States. You have no U.S. office. You don't have a U.S. warehouse. So everything is done outside the U.S. even though you as a person are American, but living outside the US. And you can get this structure where everything goes into this offshore company, and you're, whether you're a consultant or you're running an international tax and accounting firm or a dev shop or have a SaaS, you can get your tax rate to 10.5%, right? So you being the sole owner of this company, the company will pay 10.5% to the United States. You take out this 126K salary for yourself and potentially your spouse, so you're getting almost $250,000 tax free. And then what you're also doing is you're retaining that money in the company. So you're paying 10.5%, but then you're taking out the salary but nothing else. And then the money sort of accumulates in the company and could be used for investing, obviously acquiring other companies, and in retained earnings. There does need to be a plan for those retained earnings, et cetera. But you could essentially defer the rest of that money tax free. That's a lot of the setup that I do. Of course, there's other advantages like asset protection, et cetera. But yeah, that would be sort of a lot of the structures that we do to help international entrepreneurs if they want to go offshore.
Now, does this only work if somebody is willing to move out of the country?
Correct. Move out of the country, meaning, of course, you could go back to the States, but you need to be outside the US for the majority of the year, essentially 9-10 months out of the year. And by being a resident of another country, you be able to achieve these tax savings with the foreign income exclusion, the offshore structure.
Now, I have a client that runs a several eight-figure e-com company,
Right.
and he made the decision to move to Puerto Rico
Yeah.
and talked about the significant tax savings moving to Puerto Rico. I mean, when you're thinking about it, I mean, he's doing several eight figures. But let's just easy math say 10 million. 30% of that is take home. So, that's $3 million right there. If you're able to save, every 1% that you're able to save is massive when you start talking about those big numbers. So I don't know enough about the Puerto Rican tax advantages, but I have a sneaking suspicion you do. At least Puerto Rico is still United States. How does that work?
Yeah, I think it's sort of, I always talk to my clients or people that are interested in both. They're same, but they're different. When you move to Puerto Rico, you only have to be in Puerto Rico 183 days out of the year. So you're allowed to spend more time in the US under the Puerto Rican regime than under this offshore sort of expat tax regime. So that is one advantage, is essentially being able to be in the US longer. You actually do have a lower tax rate, right? It's roughly 4%.
4%. So regardless of how much money I'm making,
Correct.
I only have to pay 4%.
Correct.
Wow. And 183 days is all I have to do.
Yeah, so about 6 months. So you're looking at like basically half the year in Puerto Rico, half the year in the US. You could technically potentially spend less time in Puerto Rico as long as you spent more time in Puerto Rico than the United States. So if you were to spend like
Got it.
160 days in Puerto Rico, but only 130 days in the US, and then let's say the rest of the time you were, outside, like, in Brazil or Colombia or Europe or wherever. And then the other advantage of Puerto Rico, which you can't achieve by, what I previously described as a US expat, is zero capital gains tax. So that's why you see in Puerto Rico a lot of, traders, right? Like hedge fund traders, day traders, et cetera. And a lot of crypto traders and crypto people moving to Puerto Rico because it's zero capital gains tax on any sort of trading income. Now, if you're an entrepreneur and you're looking for an exit, then you would also potentially pay zero capital gains tax, but only for part of the capital gain, right? So it would be essentially bifurcated or divided. So let's say I have my business for 2 years, I move to Puerto Rico, and then 3 years later I sell my business, right? So then I had a 5-year hold on the business. 2 of those years I was living in the continental United States, and then 3 years I was living in Puerto Rico. So then in that case, 3/5 of the capital gain would be tax free, but then 2/5, essentially the time that I held it while living in the continental United States, would be taxable.
Let's bring this to real numbers, right?
Sure.
So I have another client that is potentially looking at an exit around $50 million, right?
Right.
So let's reverse engineer this. If he were to move to Puerto Rico, what is the difference in the amount of money he'll walk away with in Puerto Rico if he planned accordingly? So this is one of those things that, unfortunately for him, this is another situation where somebody's come knocking, they want to make an acquisition. He didn't prepare for it, but should he have prepared for it ahead of time? And should he done this Puerto Rican play? What is the difference in taxes?
I mean, again, it depends on how much time he spent in Puerto Rico versus the US, the continental US. I mean, if he were to stay in the US, then it would be 23.8%. So, he's looking at roughly $11 million, $12 million in taxes, right? If you just were to spend it in the US. But if you were, again, let's say it was a 5-year hold and 3 of the years he was in Puerto Rico and 2 years in the US, then you're looking at roughly, he would basically pay roughly 4 million in tax. He would save, 5, 6, $7 million.
When you have a business in Puerto Rico, are you allowed to still have US based employees?
For the capital gain side, you could still have US based employees. But if you were to set up this 4%, Puerto Rico structure, then technically you would have to split up the business and sort of allocate some to Puerto Rico and some to the US entity.
That's fascinating. What about this whole concept of international trusts and whatnot?
Trusts are interesting. I think there's a little bit of a misnomer in trust because a lot of times, people look at trusts as tax savings vehicles, and they can potentially save on things like estate tax or inheritance tax. But generally speaking, trusts are for asset protection, right? Especially if you're a well-known person, a well-known entrepreneur, you go through an exit, unfortunately there are sharks out there, right? And so being able to move that money or your business into a trust prevents people from trying to go after you, trying to sue you for frivolous things, right? And so, it's sort of the classic example of this sort of like, slip and fall or ambulance chaser attorneys where, they go after somebody that has money on something frivolous and say, okay, well, I'll take 1/3, you take 2/3 of whatever we win together, right? But then when said attorney sees that, the person that they're suing, the majority of their wealth is outside the United States, they require them going and making a claim in an asset protection friendly place like, St. Kitts and Nevis or Belize or the Cook Islands. There's obviously just a big deterrent there about, going and trying to lay claim to somebody's money when one, it's no longer theirs, right? It's in the name of the trust. And then two, it's in an island or a country where there's strong asset protection laws. A lot of times it's really the deterrent of saying, hey, not only lay claim, but even also try and chase the money, et cetera. It's just not worth it for a lot of attorneys or anyone. And so that's where the real protection lies.
I've actually got a number of friends that have left the country and they moved to places like Bali and Costa Rica and so forth. And they did for a number of reasons. One, quality of life, like for them, their lifestyle of, being by the water and the ocean and whatnot are great. And the other one is tax savings. But they've talked about how part of that drive to that quality of life is, they moved to Bali as an example. They're living like absolute kings. Like you'd be living at Palm Beach here in Florida, in Bali, like absolute kings with no financial pressures. They have drivers and chefs and cooks and for less money than half of what they were spending here in the US.
And I would have to agree with that. I mean, obviously, I lived that lifestyle. I've been outside the US for 14 years. I've lived in Argentina, Colombia. Now I live in Brazil. And I mean, I think it's really true, just the quality of life and the amount of the tax savings, which I've previously explained, but also just the cost of living savings, right? And I would not have been able to accumulate the wealth I've accumulated, right? And now I have an apartment in Rio and I have an apartment in Colombia, et cetera, when I was living in New York, right? Because then in New York, you're getting hit with 40, 50% plus with state taxes. And now I pay 10.5% on my company and I take out my 126K tax free, which is more than enough to live out here. And then the remaining amount I keep in my company and I've sort of used that as my nest egg. And so a lot of times, just that mere quality of life and cost of living savings is so important. I think, in particular, even when I started my own business, right? I mean, now we're just talking about sort of like the entrepreneur that's just starting or people that are, in that hustle mode. And again, being able to, build up your business and have to, get to, reinvest your money into your business as opposed to just living your life is so important. And so for me, when I started my business, which was in Buenos Aires, Argentina, not only was I able to save a lot of money, which I was then put into the business, but then was also, I got a dev team, I got a marketing team, et cetera. Obviously also playing off the fact that getting these employees and contractors was so much less expensive there. So I was able to build my team so much quicker and focus on my business.
I think that's smart. You bring up another point, which is it's not just about like how much money are you saving, right? But that gives you access to additional resources to allow you to become more competitive. If you've got a dev team or whatnot, like that's great. I mean, we have another client actually. They have an entire dev team out in Turkey, right? And so he has HQ in the United States, but then an entire dev team over in Turkey. And, it's allowed him to become far more competitive than many other companies or agencies of his type. That's pretty cool. You talked about being in New York. How long ago was that where you were living in New York?
I grew up in New York, and until 14 years ago, which is when I started my company and started this journey outside the US, I was in New York City.
So what made that shift? What made you all of a sudden one day go, I'm out of here?
A couple things. I mean, I think, one, we're looking at 2010, and I'm sure you recall in 2010, we were still in the middle of the mortgage crisis. I was working in finance. Everyone around me was jobless. Yeah, I still held on to my job in private equity, but even that, the fund was having trouble fundraising and, going where we wanted it to go. And that's when I just had this moment of I sort of the writing on the wall a bit, like with one of my bosses leaving. And then personally, it wasn't the environment that I wanted to be in at that time. And I just moved out of Buenos Aires really just because of a friend that was living there. And it wasn't until I got there that I really just saw the quality of life of living abroad. And again, the cost benefits of the fact that, it's so much cheaper to live there. And really just, I just fell in love with South America and whatnot. And so I really had that within the first 3 months. I thought it was only going to be 3 months. It ended up being 3 years, right? And it was just within those first couple months, I just knew like I will stay here by any means necessary. And at the time, because I was a practicing accountant and I had that background in tax, I just started doing tax returns for again some of the expats, right? Some of the Americans living there. And then also there was a big interest in Argentinos that wanted to open up companies and bank accounts in the United States. And that spiraled into building a website, like hiring somebody to do Google AdWords, and then having this eureka moment of, wow, people will find me online and, and get their taxes done without ever meeting me. And so that's where Online Taxman was created. We've since had other brands, Global Expat Advisors for offshore structuring. We have a new brand, Entity Inc. or Entity.inc. This is a domain, and that's for foreigners that want to open up businesses in the United States and have bank accounts in the US because that could be tax-free for them. And so it's really sort of spiraled into this, this business of really just helping people, both Americans and non-Americans, with their US tax needs and structuring and so forth.
Very cool. So you were in New York in PE.
Correct.
And so were you focused a lot on M&A back then?
Yeah, M&A and healthcare.
M&A for healthcare.
Correct.
So we've got business owners that are either preparing for an exit or aspire to have an exit. Based on your M&A experience, what are some of the things that they need to be thinking about right now in order to get the greatest multiple possible?
I mean, I think basically it's, when you look at acquisition, to me, it's something that's years in the making, right? And so even sort of going through the process early on, right? Like just with your due diligence, making sure that everything's cleaned up from like a tax and legal perspective. Nowadays you want to have at least some type of, tech or whatnot. Even for my firm, when we look at, we've acquired companies and even we might exit at some point in time, who knows? It's sort of like, okay, how can we show that we have, some sort of tech within our firm, right? Whether it's sort of like the CRM that we've built upon or just sort of the customer portal, et cetera, and being able to demonstrate that, at least in my case, we're not a traditional accounting firm, but we're an accounting firm that has tech. And, being able to also cross-sell different services. So if, like, for us, we do financial advisory, and we do like incorporations and legal work and all that, right? Because our point is to show that the customers are really sticky. And so the stickier the customers are, the more attractive it is for somebody who wants to come and acquire it, because of course a big part is going to be the customers. And so they don't want to lose customers if they acquire us, for example.
Can't you do sticky in terms of MRR, whether or not you have tech? I mean, tech is great. And I have heard that before. I just got back from California, and one of the gentlemen, he's looking now for a $200 million exit. And he took some chips off the table at 50 million. Now he's looking for a 200 million off. And his PE firm said, to get that exit, like, you got to start developing a tech. So I definitely hear what you're saying in terms of tech, but MRR and a churn rate of 5% or below, that has a very similar effect, correct?
Yeah, I mean, I think that, and yeah, to your point, and this is sort of even within my industry, which has been very non-traditional in this, like the whole notion of MRR or like a subscription model, I think has become more and more important, as if you will. And so I do agree with sort of looking at the cross-selling opportunities, looking at sort of this MRR subscription-based model to sort of show that the customers are coming back and that there's a low churn rate.
Got it. And I know that even for those people who are looking to stay in the United States and, they're just going to play the US route, I know that there's, a bunch of different strategies that they've had to plan on, to just change their corporation from an LLC, moving it into a corporation and some other, fun stuff there, just to be able to reduce a tax impact. Not quite as much as what you're able to offer them overseas, but there are ways in which they can reduce their tax impact. But again, to the point that you mentioned earlier, if you can plan 5 years before your exit, like, that's when you're going to be in good hands. I want to actually bring up one other point that you made, which is, make sure your accounting and your legal is all in order before you go into due diligence. I have heard this so many times, more times than not, actually. In fact, probably 9 times out of 10, and maybe even more, maybe 19 out of 20 times, where somebody will get an offer on the table and they get all excited about the offer. Then PE turns around and they feed this excitement. They want the person to be thinking about the cars they're going to buy, the home, the private jet, all this other fun stuff, get them super excited. And then as it comes closer to closing the deal, they find something in either legal or they find something through their accounting. And they come back and they go, you know what? We told you we were going to give you X, but we found this. And so we're only prepared to give you Y. And it's only in the rare instance where somebody did as you said. They cleaned everything up ahead of time, almost went through their due diligence before they had to go through due diligence, that they were fully prepared to answer that response. But the majority of the people are not prepared, and they do end up going all the way towards the end, spending all this time, this energy, this labor, blood and sweat and tears, because due diligence can be very, very, very difficult time period, only for PE to come back and go, nope, I know we're at the 11th hour, but instead of giving you 40 million, we're going to give you 32.
I think that the big thing is also, and we see this all. I mean, obviously you work with entrepreneurs and, I do too. And obviously I'm one myself, but it's this sort of, when you're just trying to make it happen, right? It's sort of like the wild, wild west, right? And you sort of grow up with that mentality until obviously, your company gets big, and then you sort of forget that these skeletons in the closet or things that, when you didn't have any money and you were just focused on MRR and breaking even and getting your next round, you sort of don't go back and clean that thing up. And that's why it is important, just to sort of make sure everything's tied together before you really start going through that process. I mean, just to talk about the qualified small business stock and whatnot, I mean, it is, you have to hold it for 5 years, right? When you do plan for an exit from a tax perspective, if you're in the United States, it's flipping that, whatever structure. So it's a C Corp, because you have to hold on to it for 5 years. And then after 5 years, if you sell it, then you can exclude up to $10 million in gains, right? Or let's say it's less than 5 years. Let's say I sell it in year three. This is the time. I can't wait 2 years. I need to sell now. You can also do what's known as a 1045 rollover. So you can roll over your stock and those gains into a new vehicle, like a new C Corp, and hold on it for 2 more years and then take the gain. Now there's stipulations about the new vehicle. It needs to be, somewhat in tech. A lot of times what we do is we see people that they make the exit, and then for those 2 years they start an incubator or some sort of investment vehicle like that in order to ride out the 2 years so they could get the full QSBS. But again, that's another tax saving strategy to when you're looking to exit. And again, this is where 5 years is actually, you think it's too far in advance, but it's really not, to set up that structure appropriately to achieve that savings.
Got it. So then for our listeners that are going, okay, you sold me. I need to start preparing for it. Walk me through what are the steps that they need to take to start preparing for an exit?
Yeah, I mean, I think again, it's looking at the structure and looking at, what's typical in your industry, right? How are you going to be acquired? Is it going to be an asset sale? Is it going to be a stock sale? What's your current structure? What would a potential acquiree look at and try to acquire the business? And then what are you going to do to prepare for that? Again, both like making sure that everything's clean from the past. And if there does need to be any type of restructuring, make sure you do it, right? And I think a lot of it is just hiring good help, right? Not being cheap when it comes to that. I mean, there's countless examples, even over the course of startups, where people just were not advised properly, right? For example, there's a famous story like Mercado Libre is sort of like the eBay of Latin America. It was started in Argentina many years ago, went public, etc. They went and they started a US C Corp, where really because none of the people were American and they had no business in the United States, they should have went with a Cayman entity. And because they went with the C Corp, they ended up being taxable upon the sale, and they paid an extra 20%, right, to the U.S. government, even though they had nothing to do with the U.S. It was completely LATAM-based business, and all the founders were non-U.S. people, right? But this is sort of like one of these, yeah, again, shining examples of how they just didn't structure properly on the sale. So I think it is, again, getting it right and getting it right early, or at least setting yourself up to get it right later based on, yeah, your 3 to 5 year strategy.
It's funny. So I live in Jupiter, Florida, right? And there's a big difference between where I used to live in New Hampshire and then coming down here to Jupiter, Florida. And when you look at the people that some of the people who are around here, right? I mean, Michael Jordan is about a mile the way a crow flies from my place. Tiger Woods has got a place here. Just a little further down in Palm Beach, we've got Tony Robbins, all the Trumps live over here. And then you've got people whose names you wouldn't know, but they're the ones that actually have, exponentially more wealth than everybody else. And when I talk wealth, there's a gentleman who I'm good friends with who's a billionaire. And he was telling me, he goes, as well as I've done and as much money as I've made, truth be told, I'm poor compared to the people that are around this community. I'm poor. There's that much wealth out there. Because I'm always fascinated about money and we talk about it, what I learned is that there becomes a certain threshold in your earnings where all of a sudden the people who are at one point and then at another point, they start all of a sudden doing things way differently than everybody else, way differently. And the way that they manage their money and they set up their tax structures, and many of them are doing some sort of international play, which is another reason why I wanted to bring you on, because they are doing an international play. Now, not all of them are living abroad 6 months plus out of the year. I don't know the details behind how all of that works, but they do have an international play that works out and so forth. And it's just fascinating. It's just a wonderful world of options.
No, it's true. And that's the thing. I think everything is sort of relying on one's individual situation. But to your point, I mean, whether it's setting up an offshore trust or, there's something called a captive insurance company where you have an offshore company and if you're in a very insurance heavy industry where you have to pay a lot of insurance, you could actually have your own insurance company. And, you're paying yourself, except you're paying yourself in an offshore insurance company. And so there is such a slew of options, when you get to a certain level where it just makes sense to go with that route. And again, it's obviously tax, but yeah, when you're also in that level, people really are after you. And it is sort of having that level of asset protection as well to make sure. But I think that's one of the most interesting things and what I love about the United States a lot. And, obviously it has its faults and I'm not here to discuss that. But the point is that it is a capitalist country that encourages two important things. One is entrepreneurship, right? The ability to deduct things, to, start your own business and go on, an LLC on your personal tax return, deduct all these expenses, even if the business doesn't, develop anything. It's encouraging entrepreneurship and it's encouraging investment, right? And so you mentioned Warren Buffett. I mean, why does Warren Buffett have the lowest tax rate? Because when it comes to investing in public companies, there's the capital gains tax is lower, right? When it comes to investing in real estate, there are a lot of tax advantages for investing in real estate. You could be a real estate professional, which doesn't even mean that you need to, go get a real estate license, et cetera. And this could even be something, for those out there that maybe have a spouse that, is at home or a homemaker not working, make that spouse a real estate professional by, having a couple rental properties and having them, manage it or spend some time. And as long as they're spending 500 hours a year doing some form of real estate, and they're dedicating themselves more to that activity than any other work activity, then you could deduct, all sorts of real estate expenses through, accelerated depreciation and bonus depreciation and cost segregation against, the money that, let's say, the other spouse earns. And so again, it's just another, we talk about depreciation and all that sort of thing. Again, the US encourages being an investor. And I think when you, understand that and understand that that's sort of the name of the game and how you can position yourself to go that route, even, whether it's pre-exit or even post-exit, you'll do very well when it comes to tax savings. And, as you mentioned previously, the amount of money that you save on tax multiplies just the amount of money that you'll get from passive income or from, active income. And it's really sort of like, playing both sides, being a smart investor, but also, really thinking about your tax strategy and how you're going to save.
For sure. It's no accident that I own a portfolio of commercial properties, right? For all the reasons that you mentioned, especially over the past several years where there was this bonus depreciation. In and of itself, I mean, revenue wise, when we acquired the properties, revenue wise, we knew we were going to be bringing in a negative income. Plus, there was some investment we had to make, but we knew we were going to bring in a negative income. But it was one of the smartest acquisitions that we could have made because with all the bonus depreciation and whatnot, we ended up making significant amount of money on top of that. And the cost segregation and everything like you
Yeah,
mentioned earlier.
yeah. If at least it's cash flowing, you could get your rental income, or if it's a syndicate like that, you get your distributions. So you're getting cash in, but you're not paying tax on that cash because on paper, there's all this bonus depreciation and depreciation that's happening at least up front. And then of course you could, do a 1031 exchange and you could flip it into another real estate investment and not pay capital gains tax on that. So there's this whole notion of buying and holding and borrowing against is called a BBD, buy, borrow, die. You buy real estate, you borrow against it, and then obviously, at the end you die, and then it gets passed down to your heirs, and hopefully there's limited estate tax if you put in a trust. And so, what a lot of these billionaires, et cetera, are doing. I mean, Elon Musk, I mean, he borrowed against his Tesla stock to buy Twitter or X. I mean, so there's that play when you get to it, which is sort of, tax and just financial planning and whatnot that really does accumulate a lot of savings.
For the listeners who want to take their business beyond 7 figures.
I'll go back to the tax side, but it is about sort of playing, a lot of entrepreneurs are obviously playing offense, and I think that's where people are cut out for, but it's also playing defense. And defense, in my opinion, is doing these tax strategies and sort of being on top of, where your exit's going to be and how you could potentially save on that so that, if it's your next phase in life, you are, keeping as much pie as possible.
Got it. Awesome. Now, people want to learn more about you, the work that you do. Where do we send them?
Yeah, you could go to onlinetaxman.com and, feel free to reach out to me there, Vincenzo at onlinetaxman.com. And happy to be a resource for everyone.
Awesome. So that's onlinetaxman.com. Again, that's onlinetaxman.com. Look, we've talked a lot about many different things, and really what was exciting for me was we were able to uncover much of the mystery behind the international tax advantages and plays that many of the most successful entrepreneurs have been leveraging. And even if you're not going to, relocate overseas, we talked about some of the ways in which you can benefit just domestically as well. Or even if there's a hybrid like Puerto Rico, which is still in the United States, but at the same time gives you that ability to benefit from significant savings. If you go overseas, you get the quality of life in addition to the tax savings. If you stay locally, you get the benefits of being an American and living in the United States, and there's ways in which you can save as well. The most irresponsible thing you can do is just do nothing. It's really important to just really start understanding where you want to go, where your future is. Be that one step ahead so that when your opportunity does come knocking, you're not like several of the people that we know that inadvertently give away several $1,000,000 because they just weren't prepared. So, if there's one takeaway that you get from today's episode, just be prepared. Start thinking ahead of time and be prepared. So, for more tips, strategies, and information for growing your business faster, more predictably, and less dependent on you, also check us out at predictableprofits.com. Again, that is predictableprofits.com. This is Charles Gaudet with my friend Vincenzo Villamena, and I will see you in another episode.